Good afternoon, everyone. This is Jason Hilliard with Forecast Capital Management for September 22nd of 2022. We had the Fed rate hike decision yesterday, Wednesday the 21st, and the Fed hiked by 75 basis points, as everyone is probably well aware. But what they may not be aware of is the yield curve inverted even further and is now the deepest inversion since 1982. As you can see from the chart, we initially had a 7.57 expected number of rate hikes by December of 2022. After yesterday's rate hike, which is 75 basis points, or the equivalent of 3 rate hikes, that expected number comes down to 4.74. So we kind of knew this was largely priced in, this 75 basis point rate hike. We had a 20% probability that it could have been 100. It wasn't. So the rate went from 3 to 3.25. What was not expected, of course, was the risk and the sell-off and risk. It seems that it finally sunk in to investors that while the Fed didn't do a 100 basis point rate hike, that there are going to be more jumbo rate hikes coming down the pike. So the other thing that the Fed did was take their GDP projection for this year. They lowered it from 1.7% to 0.2%, which is really an acknowledgement that what we've known for months is that we are in an elongated economic slowdown in the United States. A couple of things to note related to comments made by Chairman Powell is the odds of a soft landing are diminishing. The Fed wants to be very confident that inflation is moving back towards 2% before considering reducing rates. If the Fed wants to get to another period of very strong labor markets, it has to get inflation behind us. Pretty hawkish statements by Fed Powell. But if you're expecting that we're going to get a pivot anytime soon, that is really not in the cards. There's really no support from the labor market or inflation data to suggest that the Fed is going to pivot and become more accommodative. Right now, they're going to stay the course, and you're going to get more jumbo rate hikes going to December of 2022, possibly into 2023. Meanwhile, the labor market continues to hang in there. Initial weekly jobless claims are near the lows. The number is 213,000. Remember, the labor market is a lagging indicator. It's not, a forward indicator of where we're going. So it's a lagging indicator. It doesn't tell us much, even though the Fed actually uses that lagging indicator to decide what to do with rate hikes. Consumer confidence in the Eurozone is collapsing, and I'm going to give you a little insight into what those numbers look like, but it's not a terrible surprise. The European consumer is getting absolutely squeezed by high inflation and rapidly tightening financial conditions. They're really getting hurt by energy costs, by food costs. Basic necessities are just super expensive. So obviously, their consumer confidence numbers are going to come down. To give you a sense, the Eurozone September consumer confidence decelerated to 28.8 from 25 in August. On a country-specific level, the Denmark consumer confidence slowed to an all-time low of 32.1, while Ireland hit the lowest level since the 2008 Great Financial Crisis. It is a global rate hiking extravaganza throughout the world. And to give you a sense of what everybody else is doing outside of the United States, the South Africa Reserve Bank hiked by 75 basis points. And not to be outdone, the UAE, 75 basis points. Saudi Arabia, 75 basis points. Hong Kong, 75 basis points. The Philippines, Indonesia, 50 basis points. Switzerland, 75 basis points. Norway, 50 basis points. And Taiwan, 12.5 basis points. It's probably nothing, right? I think everybody's fighting inflation, but they're all behind the 8 ball. So they have to aggressively hike rates to bring down inflation, which hurts everybody. The other thing that I wanted to bring up is that yield curve inversion is not only occurring in the United States, but it's occurring in the United Kingdom, Canada, Mexico, Brazil, Sweden, Poland, Norway, and the Czech Republic. They all have inverted yield curves. And I forgot to show this to you guys, but the US 2 and 10 spread, like I said, is at negative 0.56%. What that basically means is the 2-year is yielding 0.56 basis points more than the 10-year. And that this level hasn't been touched since 1982. So pretty significant data points. I hope everybody is making sure that their portfolios are taken care of. I think this economic environment, but the data is pointing to this economic environment continuing through 2022 into the first half of 2023. We're not going to get a pivot by the Fed. The Fed is going to continue increasing interest rates into a slowing economy, exacerbating the recessionary environment that we currently find ourselves in. We're probably not going to see any light until the second half of 2023, but that is because of the Fed's own decision making. So unfortunately, the Fed is pulling the purse strings. They are behind the 8 ball. They haven't made great decisions in the past. They've created this massive bubble by printing money for years upon years upon years. And now we are at the point where the bubble is popping, and they are now increasing rates into a very precarious and recessionary economy. So, like I said, I hope everybody's staying safe out there. If you do have any questions about our data, our firm, or anything that I talked about in this, please let us know at info@forecastcapitalmanagement.com. You can always find us on Twitter at forecastcapmgmt and LinkedIn. So please send us your questions if you have them, or if you're just curious about anything, happy to answer them. Have a great rest of your week. Have a great weekend, and I'll see you back here next week.